Well, major averages extended their gains from Friday, with tech leading the gains. This comes as investors await another big week of earnings reports this week and two key pieces of economic data, including the January jobs and the consumer price index. Joining us now with a look at what will be the key drivers this week are Sam Stovall. He is a chief investment strategist at CFRA, and Tim Seymour from Seymour Asset Management, and of course, a fast money trader. Good to see you both, gentlemen. Tim, I will start it off with you. What is the event that you're watching very closely? We were just commenting about how the S&P seems sort of stalled at these levels here. Won't break down, won't break higher either.
I think I'm going to look out to NVIDIA, but payrolls this week is important. I just feel as if the job market is that leading dynamic, and this won't be a leading indicator, but it is the sense that the market is trying to feel out whether labor could be in trouble in this country because of all the obvious secular trends. I just think the economy's better. This call it barbell approach to investing right now, which, as you've just talked about, semis are outperforming once again, but also healthcare, energy really works. And it works as long as there are jobs out there. So I think payrolls are important, at least to set the tone.
Sam, as much as it seems like Treasury yields, maybe the dollar, have been sensitive to some maybe slowdown talks today from Kevin Hassett saying maybe labor is going to be weak. And, even the weaker secondary job reports last week, the equity market is assertively suggesting that we have kind of liftoff in the global economy. So how are you thinking about that? And how do you think that the behavior of the market tells us what's to come?
Well, Michael, I think that because we had such a snapback on Friday and some pretty good follow through today, that essentially because of the expectation that Q4 GDP could be as much as 5.4%, according to the Atlanta Fed GDP now, also looking at the possibility that if we do end up with, possibly a weak payroll number at 55,000, which is what the street is expecting, and then also seeing a decline in year-over-year numbers, both headline and core for CPI on Friday. I think the expectation is that we probably could see a rate cut at the June meeting, all of which I think would help to support and propel share prices.
Well, the Atlanta Fed, by the way, revised it down to 4.2 last week, even though the president wanted to grab that 5.4 number over the weekend. But, Sam, we've been talking just recently about the broadening of the market. You do have most stocks outperforming the S&P, and whether that, in fact, is something that can be sustainable and compatible with the overall index, making new highs.
Well, we have been seeing an increase in the percent of sub-industries in the S&P 1500. There are 155 of them, and we have seen upticks in the 50-day, 200-day, as well as both. In fact, last week, 30 of these sub-industries moved back above both their 50 and 200-day moving averages, and you had areas such as diversified metals, such as global banks and technology hardware that did move back up. So that implied that investors were certainly looking at the 8% discount that tech had been trading versus its 5-year average.